Hey, welcome to the Aramir Roundtable. Today is the 6th of December, 2023, day after our 25th anniversary. So we had a great day yesterday. Special guest, Rod is from Traders Dev Group, and I joined his group and been getting back into futures trading. I did it a long time ago, but it kind of, when I was a student with Dan Sheridan, I worked for him for a long time, and then Capital Discussions and Aramir have been kind of options. But it's kind of fun to get back into futures trading, and Rod's got something special going on with TDG, and I thought I'd invite him on here to show people how you trade, Rod. So thank you for coming on, and I really appreciate it, you spending the time with us.
Absolutely.
And
Well,
then
thanks for having me, Tom. I appreciate it as well.
Okay, and then before we get started, just the normal disclosures that Aramir and TDG are not broker-dealers and investment advisors. It's for educational purposes only. Options, futures, bonds, and currencies of all risks are not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole disclosure, go to the bottom of any of our web pages or pause recording. And with that, that'll check that square off that we've got that done. So, Rod, I'll turn the screen share over to you.
Great. Thank you very much. I'm a
Yep,
little
got it.
lazy, so I don't go into full mode. That way I can see my slides on the left. But the good news is I'm not going to spend much time in PowerPoint at all. We'll try to just get to the charts. So again, Tom, thanks for having me here. Just really quick way by way of background for me. My name is Roderick Casillii. I've been trading actively since 1993. So I'm on my 30-year anniversary. I joined Merrill Lynch in 1993 and started on trading OEX options way back then. Made my way to futures in 1997 and actually traded the first mini when it was available in 1997. So I've been doing this for quite a while. Latest iteration of my trading and education is the Traders Dev Group. You can find us over at tradersdevgroup.com. I'll provide more information as we go along. I also have a YouTube channel called The Futures Fanatic. You can find me over there on YouTube, where I create videos just about futures trading, and recently they've become very focused on these online futures prop programs. So these are a means to an end. I think they're a great educational tool. By no means do I think that they are the end all be all, and that you shouldn't have your own skin in the game and all those kinds of things. As Tom mentioned in his disclaimer, mine is, if you knew the difference between good advice and bad advice, you wouldn't need any. Don't eat yellow snow. Look both ways before crossing the street. This is just my opinion that these programs are good. But I've really changed the focus of what I do to the risk and the way these programs are structured. So if you guys are familiar with poker or anything like that, there's differences between tournament poker and live poker, although it's the same game, but you make slightly different decisions. So I just wanted to let everyone know that sort of what I'll be talking about today is through the lens of how to appropriately use mean reversion strategies and trade the futures markets for getting through these programs, to kind of learn how to manage risk and, in a perfect world, actually cash flow these in a way in which you're not putting much of your own capital, if any at all, at risk. Before I get into the details of what I want to talk about today, I want to talk about a term that I coined around how to make the best decisions possible with incomplete information. Again, analogous to poker and many other things. We're doing the best to make the best series of decisions we can with incomplete information. And I refer to that as sort of situational fluency. How do we remain fluent with the particular situation at hand? And the markets are a perfect world to practice that sort of concept. But situational fluency, I first came up with it back when I was in sales at Merrill Lynch and looking to attract other brokers and attract other clients to the firm and things like that. And whenever you're dealing with people, you want to try to acclimate to various situations. And then I applied that to trading, and I'll talk more about that today. But the idea is that everything that I do and everything that I teach and train on, and what's been successful for me, is not black and white. It's not about this many ticks and that many ticks. It's not about placing a stop here and placing a target there consistently. Obviously, there needs to be frameworks, but I think too many people are not accepting of the fact that, well, they know markets are dynamic, but they don't have really a systematic, repeatable way to make their own approach to how they execute strategies dynamic as well. Okay. If you have the ability to code up absolutely every single aspect of a trading strategy, the entry, the exit, the risk management, the sizing, all that kind of stuff. That's great. But I think us over in the retail world, that's going to be a little bit difficult. So what we need to do is become situationally fluent to the dynamic markets. I'm of the belief that there's really only four things that matter in trading. The first is high probability entries. I'm going to talk about that today in a little bit more detail. The next is risk management. So you've probably heard the second one. Maybe you haven't heard the first one. Obviously, everyone wants to be able to enter at what they believe is a high probability entry. Most people don't take the time necessary to back test or even walk forward out of sample test anything. So they don't really know what the probabilities are. They might know their stats, which is great after the fact, but they're not really aware of the probability of those particular entries. So that's what I'm going to talk about today, is that if you start with high probability entries, you're going to find that your risk management becomes easier. Why? Because more often than not, those trades are going to behave in a manner that allows you to manage the risk properly. If you are trading sort of willy-nilly, we all know this, or trading in a manner in which really it's just the flip of a coin. And I would argue that many trading strategies are flipping the coin, support and resistance, pullbacks to moving averages, candlestick patterns, all that is completely random, and your chances are probably 50-50 at best. Also, it's nearly impossible to truly backtest a lot of that. Yes, you can backtest, pullbacks to an 8-period or any kind of period moving average, but what we're going to talk about today when it comes to mean reversion is the probability that price will stay within particular ranges. And we know what those probabilities are. And then we have other factors that we can look at to help reinforce the probabilities that we're already looking at. So those are the first two things. You have high probability entries and risk management. You're halfway there. Next thing I would argue is that if your trading strategy doesn't involve volume and volatility, you're going to have difficulty, and it has to involve both of them. So we measure volume using volume profiles, not those silly, volume bars that you see at the bottom of a stock chart, which are essentially useless in my opinion. So we're going to be looking at a little bit of volume profile. And then volatility is measured by a 7-day ATR. I'll talk a little bit more about that as well. I've already mentioned this, but everything that we are going to do is about thinking risk first, always thinking risk first. And that doesn't mean that entire trade has to be planned out. I see that a lot, which is fine. You hear, think about your exit before you think about your target, or understand where your stop is before you even put a trade on. That's fine. I won't get into much of that today, but as long as you're thinking risk first, then I'm all for it. That's where we need to start. The next thing is that, I only trade for my trade room and for everything we're going to be doing. In fact, if we have time to look at some options, using micros. So I know that can be slightly controversial. I'm not exactly sure why. My experience over the last 30 years is that the vast majority of all traders in the futures markets are completely undercapitalized and don't understand how to actually trade levered products. Tom and all the members of this group, I imagine, since you're options traders, you're aware of how to, how leverage cuts both ways, and how to properly understand what you're doing when you're using levered products. But everything that I do here is about staying on the bunny slopes to develop that proficiency, so that you are not sliding down the hill and, on the black diamonds, right? Everyone wants to get their foundation and then immediately go up to the top of the hill and, go down the craziest kind of hill. And then they wonder why their decision making and everything else they do is not as aligned as when they were trading smaller. So getting to the risk budget, I wanted to start on this first before we take a look at the charts and talk a little bit about mean reversion. So if I can implore anybody to take this part of the presentation to heart, this is the most important part of what I'll be presenting today, especially as it applies to some of these prop programs, which I know that many of you listening to me in the audience are not, currently in these programs. So just really quickly, let me explain, what they are. So they're demo accounts that allow you to demonstrate your ability to produce risk-adjusted returns with very, very tight risk parameters. You can argue whether they're, realistic or not. That doesn't really matter. That's a lot like, showing up at the carnival game and giving the guy $2 and trying to, knock down the 3 milk bottles with a softball and go, this is rigged. Well, that's the way the game works. Some people can knock down those 3 milk bottles. If you're not one of them, you haven't developed the skills to knock those milk bottles down. So anyhow, I believe these programs have a lot of merit to them. So the risk budget is what it is it's the daily or session max loss that you can take. In other words, absorb or handle. Okay. Here's the reason this is very, very important, especially for futures trading. Futures trading, in my opinion, should be done as a day trading activity, a very shorter time frame day trading activity, where we're looking to cash flow these accounts on a daily, weekly, monthly basis. The type of account that you're given is very, very small. So as an example, it might be a $2,500 drawdown, even though the notional value says $50,000. So what we're going to risk is 10% of our max trailing drawdown, or $250. And then your risk budget cannot exceed your 3 best trading sessions in 20 sessions. In other words, excuse my French here, you can't eat like an elephant and excuse me, you can't eat like a bird and shit like an elephant. That's just not going to work. And that's the problem that almost all traders have when it comes to trading levered products, or really anything. I find that stock traders tend to have death by thousands of paper cuts, just because the volatility is a little less than it can be in the futures markets in terms of using a levered product that can also move quite a bit. So again, if there's anything else I can implore you to do if you're looking to be an active day trader in the futures markets, I can't say that this carries over specifically to those of you that are trading SPX or a variety of different options. Even if you're doing it on a daily time frame, you might need, you're probably looking at only the risk per trade, which is fine. But in these futures programs and in the mean reversion strategies I'm going to talk about, we're really looking to have our session risk and then not be quite as concerned with what's happening on any individual trade per se. Okay. Then the final thing, when we're talking strategies, talking about mean reversion, what do we mean by mean reversion? So as you'll see in just a little bit, I try to keep it very simple. So what I mean by mean reversion, and I'm sure many of you know the definition, is looking for price to revert back to high volume areas, or in some cases to some moving average, because we don't use that as much. Basically, for price to come back to the area in which the most amount of business took place. I'm sure everybody listening to me is familiar with this concept, but it works extremely well in the futures markets and the stock index futures. I would say even more so than, a lot more so than in equities, because we're dealing with 23 hours of data. Okay, so when we come in to trade the open Eastern Standard Time, we've already had more than 12 hours of trading activity that's taken place since the close the prior day. So we're working with a lot more data that we can work with. So when we're talking about mean reversion, we're simply looking for price to come back to these anchor points, which we'll talk about. Okay, let's go ahead and trade. Tom, how does it work here? Do you guys kind of ask questions in real time, or are there questions in there? I just wanted to do
there's a chat. There's no questions yet.
Okay, no questions yet. All right, good. So so let's just come over here to so there's 2 platforms that I predominantly look at when I'm trading. One is TradingView here. I imagine everyone is familiar with TradingView, and the other is NinjaTrader. Okay, so for the purposes of today, since I would suspect that most in the group are probably not using NinjaTrader, I'm going to use TradingView. Okay, so this is TradingView. And we're looking at a MES, the micro index stock future. And this is a very, very simple chart. It's a 5-minute chart. And what we have applied here is VWAP, 1 moving average, which is a 34-period moving average, and an indicator that is plotting 2 standard deviations from VWAP. VWAP is the blue line right here. Now, I often joke that I can teach this strategy in 2 or 3 minutes, and I actually basically can. Okay, so if we were to not consider what our brain is looking at, which is what looks like a downward trending day for this session, if we didn't consider that at all, don't be concerned with that, because if you just come back over here, right to there, before that candle right there, in a very short-term basis, these are 5-minute bars, we definitely look like we were trending up, right? We were moving up, and then we reversed all the way back down. Before I get into specifically the entry criteria and all that, let me just say what the reason I teach this strategy is because starting back in 2004, we started running all these tests, and then we've been doing them ever since. And what they've shown is on the ES, not the MES, but it should be similar. The MES has only been around since 2019. About 81% of price action during the cash session, that's going to be 9:30 to 4 Eastern Standard Time, will take place between two standard deviations of VWAP. Okay, so let me say that again. 81% of price action during the cash session, okay, which is only represents about a quarter of the entire time that the futures markets are open, you're going to have price take place between two standard deviations. That's this red line here and this green line right here. Okay, so I don't know about you, but I think that puts us in a huge advantage if we at least know that. Okay, that if you want to, so this is what I mean by probabilities. The probability that price stays within those two areas is highly probable over a long period of time. Okay, so that's a starting point. Today, I probably won't have time to get into a bunch of other filters that you can potentially use to determine when price might likely get outside the volatility bands and stay outside the volatility bands for a certain period of time, but we don't necessarily need to worry about that right now. So let me just tell you a little bit about this strategy, which is called stay in your lane, and what I mean by mean reversion, which is this is called our offer zone. Okay. And this down here is our bid zone. Whoops. All right, this is our bid zone right here. Now, strategy is dead simple. Like I told you, I can teach it to you very quickly. All right, so what we are doing is we are looking to buy in the bid zone. If we want to make things very simple and you're just learning this, it's only at the what we call -2s, or the lower green line. Okay, and on the flip side, we would only be selling on the upper red line, not the whole zone, as you're starting to learn. Okay, but later on you can build positions in the zones. So we go long here, we go short here, or we take targets on shorts here and we take targets on longs here. Now, the other target is just VWAP, and we do nothing in the middle of all of this. Okay, so if you were to buy right here, let me go ahead and actually do it. This is one of these prop accounts that I mentioned. So I'm just going to go ahead and buy at market. The actual area is right here. Okay, that's where I want to be buying right on that particular line. And then my target on this long is right here. Okay. Now, this is like somewhat controversial. I don't suggest people trade without stops, but when you're at a high probability entry point, your ability to manage risk from this level is going to be a lot easier. Now, does that mean that there's an 80% chance that it's going to revert off of that lower line? No, it just means that 80% of price action is going to take place between these two lines. So if I had to use a stop, I would use something like 20% ATR. So let me get into ATR real quick, and we'll get back to this strategy. I use the ATR over here. So here on NinjaTrader, I have a column here that says ATR. And if you can see this says 36, that says 262, this is 200, and this says 33. So let's talk about the S&P. So that is a 7-day ATR with a 23-hour period. So the full day, 7-day ATR. Average true range. I imagine most people are familiar with average true range or average daily range. Here we're talking about average true range. So what that is 36 points. 36 points represents over the last 7 days what the 23-hour range has been in the S&P. It's been 36 points. Okay, so 36 points, if you're not familiar, is pretty low on basis. We'll at some point next year, I guarantee you, I used the G word. I guaranteed something. Highly likely at some point next year we'll be trading 100 ATR or higher, meaning expecting a range of 100 points. If you've been following the markets, which all of you have been, the last couple of weeks, I don't think in the last 10 trading sessions we've had anything more than 1% And I think we've been at like less than right around 0.5% moves in the S&P for the last 5 or 6 sessions. So that's caused the ATR to come down. This is the measure of how fast our car is going. And another thing you can do is take this level of 36 and multiply it by the point value. So you take 5 times 36 and you're going to get $180. Okay. So that means there's $180 of opportunity or risk. And that's if you buy the low, sell the high, or do the worst part, right? Get stopped out on the high tick and get stopped out on the low tick. So somewhere in between, we should be able to manage against this low ATR value here. Okay, so 36. So we're going to use this, and then we're going to use a volatility profile here. Let's go to crude oil is having quite a day there. So we look at this right here, and this is a 30-minute volume profile chart. And we can see that there's been 29 points of range so far. So on average, okay, we'd be looking for another 6 to 7 points of movement. And that would just take us to the average. And that could happen in, 1 5-minute bar or something of that nature. But that would just take us to the average. So far, we're well into the trading session. And remember, we're marking the trading session from last night's open at 6 p.m. And here we are trading a little past noon, and there's about 3.5 hours left in the day, and we still haven't even experienced one full ATR yet. Okay, so the reason I point that out is because that's how we determine how fast the car is going in our mean reversion strategy, which is as we decide to buy this bid zone here, we're aware that overall the volatility is pretty low. We're trading, we haven't even put in an entire. Now, does that mean it's going to move lower to take up the rest of that expected range or go higher? I have no idea. It's simply, it's completely random, right? But the probabilities that we only have another 6 or 7 points in one direction or the other, especially if it was down, because if we started to move back up, we still wouldn't be adding any additional range because we came off of these lower levels. One thing I don't want to do is be super, recency biased and show that today, look how well, of course, the offer zone sold off to this level, how well the bid zone then held. And then now, we had this little, what I call scare the children, move down to 45.71. So what I was getting at, though, to show that ATR is if I wanted to have a stop on this particular trade, again, which should be a higher probability trade and an easier one to manage risk. I'm now long a 2 lot. I'm going to go back to this ATR right over here, and I'm going to take 20% of that ATR. So let's 360. Let's just round it up to 8 points. So my stop would be about 8 points if I wanted to use a volatility-based stop. Now, again, I don't use stops because these are very, very easy trades to manage, but I'm not going to allow some trade to eat into 20, 30, 40, 50% of my risk budget. Remember, we talked about risk budgets before. So my risk budget is $200 or $250 for the day. You can see that this thing would have to really start to go significantly south, which it could, at which point I would look to make a decision as to how much I am willing to allow this to eat into my daily risk budget. Now, there's probably a lot of people listening to me that would want this to be a lot more mechanical and a lot more systematic. And I get that. That's why I gave you a starting point where you could use an 8-point stop or a 7-point stop. Okay. The other thing that's nice is that you never have to use a set target. The target is 100% dynamic. So if I were going to use a 20% ATR stop, which would be about 8 points, I would want to have at least a 1-to-1 or better. So if I'm long from 45.72, we're going to get up to 45.82. That's better than 1-to-1, right? It's a 12-point target with a 8-point stop. Okay. Now, the stop, as I said, is something that can be however you want to manage things on the downside. That's the most important thing, is to think risk first. But this level up here is not disputable. That's where you're going to want look for your target to be. Okay. You cannot have 20% ATR stops and then take targets earlier, or it's just not going to work out. You have to allow price to go to your particular level there. All right. So I've just basically taught you this strategy. We can talk later about sizing, and all those things have not really a bearing here. But what we're doing is we're buying in the bid zone and we're selling in the offer zone. All right, that's the primary way to trade this particular strategy and look for it to mean revert. So now let's go over to the range trader, which these are complementary strategies. It's called stay in your lane. And let's talk about mean reversion on a 30-minute time frame. Okay, these shaded areas here is a proprietary indicator for our group called the extreme turn. It's using RSI and ADX to identify potential turning points in the market. You can see it does a pretty good job generally of finding those particular turning points. So the first thing I wanted to talk about here is we have slightly different levels. This orange level here is a 233 EMA. By the way, at the end of the presentation, I'll just drop some links in the chat. You can always find out more over our website. I'll give you a worksheet to set up all these indicators on TradingView, and the same thing on NinjaTrader. So it'll tell you all the different indicators to use that are generating what you're seeing here. So the first thing I have here is a volume profile over here. This is called visible range. You can think of it a little bit like an anchor VWAP. So it's going to be showing me the profile for the amount of data that I have on the chart. So as I tighten this up, it could move a little bit, but for now it's looking pretty strong. Orange line here, yellow line here is the volume point of control, or what's called VPOC, the highest volume node. But you can see that this is essentially creating a little bit of an arrow. And what do you know? Price has reverted right down to this level. Now, if you look, as I tighten this up, this was sitting here the whole session. So even when we were up here this morning, okay, when things look like, oh, we're going to take a straight shot to these highs from over here, 4,600, reversed hard and mean reverted right back down to here. So the levels on this chart, and again, you can get all this from the information I'll provide you. This is a 233 EMA. It's essentially, I only use two moving averages, a 233 and a 34 on slightly lower time frames. Why? We just back tested the heck out of all kinds of things and found that the stock indices tend to respect this 233 EMA the most in terms of a way to look for mean reversion as well as quickly determine trend. So as you can see, as indicated by this being relatively flat and price being on both sides of it just within the last couple of days, we're in a non-trending market. There is no trend here. This is a good setup for the mean reversion type of stuff that we're doing. As this line would begin to slope, like a little bit of a slope here. So if you just go back, I'm going to try not to cherry pick too much, but just look at the relevance of this 233. Price mean reverted right back. Got below it for a little bit, but didn't want to. And we just happened to be in a nice market. If we had gone to November, of course, November was a time where we were just up and away for all the stock indices for a while. And there's ways in which we can adjust to that. The stronger the trend, the more pronounced the slope of our 233, the more we're going to wait for extreme moves away from that level before we would look to get short. Obviously, again, cherry picking, you can see how well this extreme turn sell caught the top of this particular move, and with a double bottom little here, how well it caught the bottom of this level here too. So we're adding some other things in here as well. But what we got going on in here is our 233 EMA, which is very important, and then our prior session highs and our prior session lows. Okay. Now, this is a prior session high and prior session low right here and here, okay? So for mean reversion, what we are looking for is we are looking for price to be staying within the prior session's range. This is a little easier to see on NinjaTrader, so I'm just going to go to NinjaTrader for this. Okay. So this is the prior session high right here, which we were above earlier, and here's the prior session low. So on the range trader, we actually draw in some levels, our bid zones and offer zones. Remember, on stay in your lane, we don't have to do that because it's just being done by the indicator. So there's a little bit of discretion here. This is our offer zone up here. This is our bid zone down here. This is our no-go area right here. On the range trader, now remember, I am long a little bit of MES that I showed you at the -2s on stay in your lane. So these strategies are complementary, but they're also independent. So there is no long here on the range trader unless you wanted to use T-line as an entry, which you can buy the pullbacks to T-line. But if you are doing this the purest way, you do not have a long until you get down here into this bid zone, the prior session's low, and you would not have a short until you get up here. If you get long here, your target is back at T-line, or there's other targets you can use as well. If you get short here, your target is here at T-line. So today is a day in which obviously it's working out. It's nicely that it's working out. We have sold off from this offer. By the way, this box was here this morning. I didn't put this box in when we stopped there. This box was here this morning. It was informed by the fact that the prior session high, where we would often draw the offer zone, is significantly lower today on a tight range than this much clearer connection of this line here, right here, with this line here. That created this offer zone. And again, there's a little bit of discretion, as I said here. These are standard floor trader pivots that put us up at R2. And then today we just happened to get a really nice reversal right off the open, right down here to this particular level. So again, I can show you this strategy in, just really quickly. This is way after the fact, but this would be a sell there and a buy here. Same thing. If you get short here and you want to use 20% ATR and 8-point stop, you can absolutely do that. If you got long here and you want to use an 8-point stop, you could absolutely do that as well. And hopefully you're seeing that when you have orders resting away from price at levels that have been respected in previous sessions, or in the case of today's session, there's no guarantee but it's a much easier trade area to enter into. The other thing that I like about mean reversion is that for the most part, it's going to keep you out of over trading. There's just not a lot of signals on this range trader. Okay, as you can probably see there, there's not a whole lot of signals. Now let me go in here and put in some bid zones and offer zones. So up here, same thing. This is going to be our offer zone. Now, sometimes between the range trader, which is this 30-minute chart, and let me go here, big white font. Okay. Sometimes there'll be overlap or confluence between the levels on the range trader and stay in your lane. Other times there won't be. Usually it lets me copy and paste this. There we go. And then down here is our bid zone. Big white, oops. Down here's our bid zone. All right. So in the interest of time, so that I can also get to a little bit of options, and I know we kept this very high level, we've basically gone through two different trading strategies, the range trader and stay in your lane. Let me show you stay in your lane here on Ninja Trader because it looks a little different. I'm using a different bar type. This is a modified Renko where you can actually set the offset of that Renko. It creates if you guys are familiar with the Renkos, these are going to look a little different than your standard Renkos, although they've started to add Renkos that also have wicks. So we call these brick wicks. They're just configurable. But the strategy is not any different because we're keyed in on the lines. This is our -2 down here at 1870. Let's go to here. Okay, so this is our -2 level here at 45.69. And that should correspond to the same level that we have here, right here, of 45.69 right there. So it's the same level. So here's what I wanted to get at is that now that we have offer zones and bid zones on two different strategies, we can also look for overlap or confluence, times in which we have levels on a higher time frame that correspond to our levels on stay in your lane. And when we have that, I become interested in potentially expressing a directional trade using options. So let me explain what that means. So I know that I think Tom had said that there's a lot of members of the group that are a little afraid of technical analysis and they don't like to look at the underlying on the chart. And I kind of get it. You're looking more at the options chain and how you're constructing those things and the volatility profile and all of your Greeks and that stuff. So it's just it's slightly different. But I'm going to show you today how you can use these high probability entries to express directional trades using micro options as an example. So the MES right here, this is our bid zone. So while I'm long right here, let me put in another target, which would be like the 34 right here. So here's another target, the 34. So I'm long the S&P right here in the bid zone. Gives me an opportunity to also express this directionally using options. So let me show you what that means and how that works. Okay, so we're going to come over here and we're going to go to indices and to the micros, okay, for Friday. And I know that since this is an options trading group, you guys are going to want to probably have a lot of questions about the mechanics of, days till expiration and strike and all that stuff. So I'm going to make it super simple. We're just going to use the shortest time to expiration. So if today's Wednesday, these trade just Friday options. There's some others, the ZNs and some others that trade Monday, Wednesday, Friday. These are just Friday. So unlike the SPY and some others that have multiple expirations, this is just Friday. And by the way, we're not getting really fancy. And if you're not familiar with futures options versus regular options, one of the most powerful aspects to them is that they're only assignable as one of the underlying, not 10, not 100, not a multiple. So you really don't need to spread. There's no reason to spread because they're assignable just as one of the underlying. So if I'm going to sell a put, which is what I'm talking about here, I'm going to use the 50 delta and I'm just going to sell that put. So but the first and most important thing is understanding why we're doing that. We're doing that because we're just going to express a long trade by being short puts here in the bid zone. And we're looking for mean reversion. What's also really nice about this is I don't have to care too much about any of the Greeks or anything like that. It does not matter at all. I mean, I know that some of you got to think that I'm just speaking nonsense here, but it really doesn't matter at all. All we're doing is just choosing to express a trade directionally using an option instead. So if I go, sorry, I keep forgetting what the price is. Sorry. The price in this level is 45.70s. All right. So the 45.70s we'll say is around our 50 delta. Now, look at how anemic this volume is. Agreed. It's really, really anemic. Okay. So we're going to have to, of course, work the exact order that we want. 45.70, if we were to sell a put right here, again, without getting too much into this, the value of this is the 1 point value times the value that you see here. So if I'm going to sell at 1750, it's 1750 times $5 is going to be my credit. All right. And I'll actually put this trade on so you guys can see 1750. Should get a fill here. Yeah, should get a fill there. So that's it. So I mean, that's literally it. And I can now just sort of open it up for questions. We're using mean reversion. Now, where would be my target on this? Obviously, the most amount of money I can make is what I sold at the premium that I brought in. But what makes this pretty easy is I'm actually just going to target taking it off when it hits the target for the underlying. Okay. So one of the targets for the underlying could be here at 45.83. Another one could be here at 45.90. All right. Now, yes, there's a little element to this that make it a little silly. Why would I be selling a put there when I can just get 100 delta by going long the underlying? Absolutely. We can talk more about that. It's just a different way of expressing the same trade, and it gives you a lot more of a little fudge factor. If you're day trading the futures markets and this trade were to go against you, right, you may have to close that out for a loss, where if you're short the put and it goes against you, you know where your risk is. You could be assigned at the value at which you sold it, at the strike that you sold it. But again, it's only one. So really the margin requirements and everything are exactly the same as the underlying, if that makes sense. Okay, let me come over here to the chat.
I don't see anything in the chat.
I don't either. So either everyone's asleep and bored, or why don't I
They
open it
get
up
it.
now? If you guys have any questions about what I went through, I know I covered a lot of stuff pretty quickly, but we try to keep this to about an hour, right, Tom?
Yeah, I mean, you can go over if there's questions, but
Okay.
let's see. Enrico says all good.
Okay.
Justin says makes sense what you're saying.
Yeah. So yeah, if you had any specific, questions, I could answer them. Let's see here. Let's come back over to this. So that trade that we put on right there, as you can see, is working out for now. If you had a little bit more size from your entry, if you enter in the offer zone here, you can actually look to take one off at this line right here. So as an example, over here, I still have a one lot on here, and I'm just gonna close it out as it got back up to T line. I entered this at the same time that I entered over there while we were doing the presentation.
And T line is the 233 EMA, right?
Correct. T line is a 233 EMA, and we have the way I used the T line, everybody, is it's for higher time frame trends, and for some of you 30 minutes might not be high enough, but it's 30, 60, 2-hour, 4-hour daily. I do not use a 233 on any time frame lower than that. It's like on a 5-minute bar, but we do have some members of our group that do that. We just never really tested it. It's meant to be a way to quickly identify trend on a 30-minute candle. Okay. Is members of the group, are you guys familiar with futures options? I know that Tom said that some people trade them, some people don't. This is StoneX, which bought gain a little bit. Yeah. So again,
And
I
most of us are
emphasize
using Thinkorswim.
Pardon me?
Most of us are using Thinkorswim for the options trading.
Okay, yeah, well then you can get an options chain for if you have futures data on TOS, then you can look up this, you can look up the prices of these futures options. Again, the mechanics of it is relatively simple. You take the point value. So the point value in the S&P MES is $5 a point. If you were trading the ES, it'd be $50 a point. So in the MES, again, you just take these values. If you were going to I would suggest you never, ever, ever buy a futures option. I mean, there might be some instances in which you want to do that, but for the most part, I don't really see the value of buying futures options, given the fact that, I mean, obviously they have some value. You can use the leverage and things, but the margin requirements are essentially the same as the underlying, and they don't make a whole lot of sense. So in other words, that's why I generally like to be short, and you can think of these generally as strangles. So except for the fact that I'm going to leg into that and not put it on at the same point. So we were talking about this 45.70 level right there, selling that put. I did get filled for 17.50, so you can see it's up a whopping 50 cents. But yeah, that's what you do. You just take the value that you see there, you multiply it by the point value, and that's the amount that you would pay, or the credit if you were short. And again, I'm happy to talk more about this, but in my world, I don't see any reason with the micros to ever be spreading these for margin, because you don't really need to do that. It does obviously lower your, you do get span margin, but it's just not necessary. Use perfect. Yeah, you can do it on there for sure. Let me bring up an options chain here for you guys. So I was trading ZB here this morning quite extensively. This now says Apple. There we go. So you can trade these all these options on futures on Interactive Brokers. That's my broker of choice as well. But again, for me, it all starts over on the chart. That's all I was that it starts on the chart and starts at high probability areas for reversal. And if I'm going to be selling puts or selling calls, I'm looking for the price to hang out there and go in my direction. And if it goes, of course, against me, I have a decision. You can just cover for a loss. But the other thing that's nice about the futures markets is you can also hedge that off if you wanted with the underlying, because you don't have to, you can't do that really with stock options. You can if you have very large accounts, but most of you are probably just living within the option and not hedging that out with underlying. Whereas in the futures markets, especially with something as small as the MES, if you were to sell a 45.70 put and the market started to decline dramatically, my suggestion would be you just cover it, take it off. But an alternative is just to short one of the underlying, and then you've basically boxed your trade, right? You've boxed your trade. So the reason I don't like to do that often is because the worst case scenario is you sell a put, the market goes lower against you, and then you get all turned around by selling the underlying to kind of hedge that off. And then 2 days later, the market rallies 35 points the other way. And now you're screwed, right? Because the premium you brought in is not covering what you're losing on the short that you put on there. So I try not to get sideways. Is there a large margin difference between IB and gain? No, there shouldn't be any at all. No. The one thing with interactive brokers, as you probably know, I don't know the case on TOS, they're pretty stringent and they're very conservative. So they don't really assign day trader margin. You can request it, or you can request half of the initial margin for futures, but they're not really a fan of that. So another reason I like interactive brokers is because they're not doing this silliness that NinjaTrader and AMP and all these other firms, for the last 10 or 15 years have been vastly over leveraging people by allowing them to trade, $500 S&P, NASDAQ margins.
Let's see. And Mike says, what would be a realistic goal for a trader using your methods to set and try and get a funded account?
Well, Tom, you started with my group. What do you think as a newbie?
Well,
I always try to
my
err on the side
target's
of take your time.
Yeah, my target's like $50 a day. So if I have a $1,500 profit target, it's about 30 trading days. So I'll figure about 6 weeks.
Mm-hmm.
And I love the idea of a risk budget. That really keeps people out of trouble.
Yeah, that's the one thing you can't violate, everybody. If you want, I mean, a lot of people get hung up on how to manage risk with each individual trade, or they take 2 losers in a row and they say, I'm done for the day. All those things are fine as long as you're managing risk. But I find that session risk budgets work a little bit bigger. And so that's how Tom's doing it. I mean, obviously nothing works perfectly linearly where, you're going to average that over the whole course of a period of time. There'll be some losing days in there as well, and some outside days gains as well. But I led off with the concept of situational fluency. So if you put in the work over time, your skills are going to improve. With these, especially with my trading strategies, trust me, you're just going to begin to have more and more faith in the magic lines and the levels, getting over that fear, uncertainty, and doubt of going, oh, it's clearly going lower, it's clearly going higher, and try to remove all that toxicity that so many traders have in their head trying to predict price action, which is impossible. You can't. And instead just go, you know what? I feel comfortable that I can manage the risk in this particular level because of all the things I've seen from walk forward testing this. And then what will happen is your averages are going to work out, but you'll eventually be able to have what very few traders have, which is large outsized gains, keeping your losses minimal, what you're always supposed to do, but having, we have members of our group that send me emails that say, I've been doing this for 4 or 5 years, or since the beginning of Top Step, I blow up accounts, it hasn't been working. And I just had a $400 day trading 2 micros. How's that even possible? Well, because they took a bunch of trades because the market was moving and undulating in a way that was conducive, that was cooperative with the strategy. I trade at gain, large difference, IB too expensive. Yeah, for the most part, yeah, I mean, IB is going to be, I don't refer to it expensive. It's just it's an institutional broker that's allowing retail traders to trade there. That's all. So, okay. So hopefully, Michael, that answered your question on that. You cannot trade futures options at any of the prop programs for now. It's just underlying. So I was just giving you an example of how this could complement or supplement what you're doing. There are a number of people that feel that they're more multi-day traders or range traders outside of a single session. So you can express those types of moves using the options markets if you want to give yourself a little bit more time. So the actual bid zone, for instance, on this S&P would be 45.55, not the 45.70, which is the 50 delta right now. So should the market decline down to this level here, MES right here, right in here, you see, well, I'll draw on this, what we call the bid zone here, right here. So there's our bid zone down there. This will be my sell put zone for the 45.55s. And today's Wednesday. I would love for this thing to tank and give me the opportunity to sell those puts leading into Friday. But we'll see what happens. For right now, it's looking like this is about all we're going to get for the majority of this session. There's a lot of time left. It could sell off and break down into the lower end of that profile, but that's all that's happening right now. Okay, any other questions? Let me bring up my website real quick and drop in the chat. Like I said, I would give you the, let me, so here's my website. And let me give you the two worksheets that I talked about. So over here, so the first is the TradingView indicator quick hit guide. And what that's going to do is walk you through step by step how you can apply all of these indicators to TradingView and have both these strategies. It's all the indicators except for that extreme turn. So that's just for members, but all of the other indicators are either just standard indicators. Obviously, everyone should be aware of how to put a 233 EMA on their chart. Or they're free. They're free from TradingView, or they're part of something that developers develop for the community. So there's that for. And here it is for anyone that uses NinjaTrader. And anyone that comes over and does a trial to the trade room, you also can get access to these documents as well as this entire workspace for NinjaTrader. If you wanted the workspace for NinjaTrader, you can get access to the entire workspace for NinjaTrader as well. This entire workspace is available for free in those environments.
How often do you update that workspace?
Pardon me?
How often do you update that workspace, or when was the last time? Is it still fairly current?
It's very current. Yeah, the one that's in that room from 4 or 5. Yeah, so almost not. I've been doing. I don't think there's been a significant change since 2019. So
okay.
Yeah, what happened was Ninja. When they launched Ninja 8, they had that built-in order flow suite that they required you to have a license for. And once I saw that, I said, you know what, I'm going to stop with any kind of third-party indicators. Just build something out that anybody that owns a license to NinjaTrader can utilize. So yeah, it hasn't really changed dramatically at all. If you go back to the Futures Fanatic Foundation course in 2019, the charts will all look the same. Everything's the same.
Very cool.
Yeah.
Let's see. Oh, there's something in the Q&A. Let's see. How long do you think it would take a trader learning your methods realistically to get funded? I guess we answered that one.
Yeah, I think you answered it. I would, in addition to what you had said, based on 6 weeks and that, I look at things a little bit differently, is what kind of streak can you put together never exceeding your risk budget? If you can put together a 2 or 3 month streak, I know that sounds crazy to some people because I don't want to wait 2 months to get through these things. But if you can put together a month or two without ever exceeding your risk budget, then just the math is going to work out for you where even small hits, you're going to pass the thing. What screws everybody up, especially with trailing drawdowns, is big red days. They're making nice progress and then they have a setback by violating their risk budget. And if your risk budget's only about 10 to 15% of the total drawdown, which is your entire account balance, right? That's how these games work. You have a $1,500 account. It's just small account trading. Can you take 10 to 15% daily losses before you double your account? Turn that 15 into 3,000. The math will work out as long as you avoid those days in which you dump all of your gains. I know it's easier said than done, but it's not that hard. Just hit the close button. So, but we did answer that. Any other questions?
I think you also mentioned if it's a live account, like your own money, use a little bit different daily risk budget, like 3.5%, I think you said.
Yeah, well, and for accounts under for accounts over 25,000, that makes sense. Accounts under 25,000, it's going to be difficult to do that. So my live accounts are pretty large. But the ones that I show in the room, like for instance, this one right here. So yeah, you're correct. So this account right here has 10 grand in it. So the risk budget that I have on this account is $440. So that's about 4%. Yeah.
Okay.
The larger the account, the smaller that percentage will be. So on some of my much larger accounts, I also have a per trade risk, which is about 30 bips, somewhere in there.
Mm-hmm.
I don't like to risk more than 20 to 40 bips of my account. And if you guys know, that'd be 0.5% on any particular trade. And you'll hear that a lot out there, but it's not applicable at all to the prop programs because the prop programs are, again, they're accounts that are 1,500, 2,500, and that's the entire account value, right? I hope that not many of us would ever put even 20 or 30% of our entire account value at risk in any given day, regardless of the size of the account. But clearly, the smaller the account, the more difficult it is for the math to work out.
Right. And Hamal asks, is the replay going to be available? Yes, I posted on our YouTube channel, so it's Aramir on YouTube. I guess I can look that up if you're new. Hang on a second.
Yeah, and one other thing on my website is I have an entire 30 video course of which some of these strategies are reinforced on there. You can get that right here. It's right there. And that goes through more. I mean, I just gave a really brief overview. So about 6 or 7 lessons in there, a deeper dive on stay in your lane and the range trader, as well as some other considerations.
All right, great.
Yeah.
Well, I think that should do it.
Yeah, thanks again, Tom, and appreciate it, everybody. Let me put my email in here as well if anyone wants to email me directly to find out more about tradersdevgroup.com. And if you had any further questions, you can just email me there. I can also provide more information about some of these prop programs, which again are really good learning tools. And if you're gonna, I don't see the email.
Oh, you sent it to hosts and panelists, or I'll send it to everyone.
Sorry. There you go.
There you go.
Yeah. So, super. Well, Tom, really appreciate you having me here, and thanks for everybody's time. And have a, as I always sign off by saying, stay green and trade like you mean it.
And just my perspective, again, like you said, new to the group, but it's a really great group of people. Rod's very diligent every day. He's in there for about hour and a half or so at the open trading, and answers questions, very open, honest, and lots of experience. And highly, highly recommended. So thanks again, Rod. Really appreciate all you're doing for everyone. And thanks for bringing some education here for everyone in Aramir.
Yeah, you're very welcome. All right.
All
Thanks,
right.
everybody. I'll sign off
Thanks.
here. Appreciate it.
See you guys.
Bye-bye.
Bye.